Over the last half-decade, one heavy industrial manufacturer executed a turnaround so mathematically precise, it vastly outperformed the technology sector. This chart directly contrasts General Electric's stock performance against the broader market. While the Dow Jones Industrial Average returned a broadly flat 39%, GE delivered a 348% return to its shareholders. A yield of this magnitude usually requires launching disruptive new product lines or acquiring massive competitors to artificially inflate total market share. GE did the exact opposite. They dismantled their own empire, systematically tearing apart legacy divisions and isolating their core operations. The market is currently rewarding disciplined corporate contraction over top-line bloat. Looking at this restructuring strategy, we see the sheer volume of revenue intentionally destroyed. In 2020, GE carried $75.8 billion in top-line revenue. Management divested low-margin divisions to save the core. Top-line revenue dropped to $45.8 billion, but operating margins inverted to a positive 18.68%. This efficiency divergence chart maps that exact inverse relationship. Notice the crossover point here in 2022, where the red revenue line drops below the surging green operating margin line. When management strips away low-yield, toxic assets, the mathematical average of the remaining core operations naturally rises. By halving its top-line revenue, GE transitioned from a bloated, failing conglomerate into a highly concentrated, strictly profitable enterprise. Before analyzing the balance sheet, we must establish the physical industrial reality of this operation. These heavy manufacturing lines require immense capital to maintain. This chart tracking the profitability engine shows how GE attacked its corporate overhead. Selling, general, and administrative expenses, the costs of running the corporate structure, were slashed by over $8.5 billion. This creates operational leverage. When fixed corporate costs are severely lowered, a much higher percentage of every new dollar earned flows directly to the bottom line. That leverage directly rewards shareholders. Return on equity, the measure of how effectively management uses investors' capital to generate profit, climbed to an elite 45.9%. This suite of charts demonstrates this profitability cascades across the income statement. Gross, net, and EBITDA margins all expanded simultaneously. Return on assets followed the exact same trajectory, recovering to 6.9%. This confirms the gains are systemic operational improvements, rather than one-off accounting adjustments. Revenue is vanity, but margin is sanity. GE engineered a high-yield profitability engine that requires far less capital to operate. This balance sheet visualization highlights the existential threat GE faced in 2020, with total corporate debt peaking near $75 billion. Over 5 years, management evaporated $54 billion of debt. The tangible book value line now crosses comfortably above liabilities. In 2020, massive interest payments consumed 101% of GE's free cash flow. By 2025, that burden was compressed to just 11.4%. To achieve this, management utilized a highly technical lever, working capital management. This strategy optimizes current assets and liabilities, unlocking cash trapped in daily operations. Looking at this working capital efficiency grid, the cash required to run GE's daily operations plummeted from $30 billion to $1.61 billion. They compressed their working capital ratio to a hyper-lean 0.74 by stretching accounts payable out to 126 days. By delaying payments to creditors for over 4 months, GE holds on to its cash longer, effectively forcing its suppliers to finance its daily operations. GE de-risked the balance sheet while untrapping billions in previously frozen capital to fuel the turnaround. Accounting theory aside, the ultimate proof of a successful corporate turnaround and fundamental business health is cold, hard cash. This chart validates earnings quality, comparing cash flow versus net income. By 2025, GE generated an operating cash flow of $8.53 billion. That cash influx cleanly matches reported net income at 101.96%. The earnings are pristine, backed by real liquidity. Following that money into the 2025 capital allocation funnel, we track exactly how management deploys it. After subtracting $1.15 billion in mandatory capital expenditure to maintain physical machinery, GE generates over $7.3 billion in pure free cash flow. Looking at their investment trajectory, management protected their technological edge. Despite aggressive overhead cuts, R&D intensity actually increased to 3.44% of total revenue. The remaining capital flows into this shareholder reward waterfall. In 2025, management returned $9 billion directly to investors. They aggressively executed stock buybacks, reducing outstanding shares on the open market, while simultaneously expanding their dividend payout. GE has become the ultimate blueprint for a cash cow that ruthlessly rewards ownership. The operational execution is mathematically flawless, but the trading floor already knows this. Looking at the GE investment scorecard, the company earns clear A+ and A grades for profitability, balance sheet health, and shareholder yield. The only remaining friction point for a new investor is the valuation. At a P/E ratio of 35.55, the stock is priced for perfection. The bull case argues a 12.9% return on invested capital and explosive cash flow justifies this premium. The bear case warns the 348% run front-ran improvements. Any slip leaves zero margin for error. Investors initiating positions today are no longer betting on a distressed value turnaround. They are paying a premium for flawless future execution. GE proved that systematically shrinking a business is sometimes the only mathematical way to save it. They shed $30 billion in revenue, liquidated $54 billion in debt, emerging as a cash flow fortress. The question is whether a 35x multiple is a fair price to pay for an industrial giant with a pristine balance sheet. Let us know in the comments if you think all the good news is already baked into the stock price, or if management will continue to generate alpha. Subscribe to Stoxcompare for more data-driven, fundamental equity analysis.